Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 2nd of October. My name is Fook Hien and I'm your host for the podcast. Your regular host, Daniel Lam, is currently traveling at the Asian Games where he is representing Hong Kong, China in chess. So I will be covering for him as your host for the next few days. Today we're officially in Q4, the final quarter of the year. September saw some big milestones, as I said last week, where US 10-year government bond yields reached a high since October 2007. That is a 16-year high. The rising bond yields also boosted the US dollar higher. It reached a high for the year in September, with the DXY index up 2.5%. On the other hand, equities in the US and globally saw the worst month of the year in September. The US S&P 500 was down 4.9% in September, while global equities or the MSCI All Country World Index was down 4.3%. So with all the big moves we are seeing, it was only right for our weekly Market View publication last Friday to address the question, is this a good buying opportunity? So one of the good opportunities we see is in developed market government bonds, and I spoke about that last Thursday. For today, another opportunity we like, and this is especially for you if you agree with us that US dollar is likely to weaken over the next 12 months. And that is emerging market or EM, local currency government bonds. Let me lay out three reasons. First is the view on the US dollar, because for a dollar-based investor, FX can have a significant impact on returns when you buy the EM local currency bonds. Now, the key drivers for the recent bounce in the US dollar index have been the resilient US economy or US exceptionalism, and the Fed's guidance for rates to stay higher for longer. However, we are now seeing the convergence of economic surprise indices between the US and the rest of the world, which suggests the US exceptionalism narrative may face increasing headwinds. We expect US growth to slow significantly into the turn of the year, and we believe the Fed is unlikely to hike rates further. And this should result in near-term consolidation of the US dollar and then an eventual pullback over the next 3 to 12 months. Second, we like the yield of over 6% today in the asset class. This is especially the case given the prospect for bond price gains from lower yields as EM central banks loosen monetary policy in response to softer global economic activity. Third is the recent news that India would be included in the EM bond index from JP Morgan, which potentially leads to $30 billion of inflows supporting the asset class. Hence, the three reasons to be overweight EM local currency government bonds. That is all from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.